Section 2. Trading Strategies. In this section, we're going to examine several trading strategies involving options and possibly their underlying assets. We'll see how they can be useful to the parties involved. First, we'll consider trading strategies involving an option position and an asset position. In the following graphs, the red dashed line indicates the profit in the asset position, the blue dashed line for the option position, and the black solid line for the combined position. Consider the combination of writing a call option and buying 1 unit of the underlying asset. From the graph, we can see that if the asset price drops, there will be an unlimited loss for the short call position. With the long position of the asset, this potential loss is covered. Therefore, this strategy is also referred to as writing a covered call. The writer of a covered call earns the option premium, and as long as the asset is bought at a low enough price below the strike price, the writer is assured of a profit. The potential loss for the writer of a call option in the bull market is prevented by taking a long position of the asset. However, in the bull market, the writer is better off not writing the call option. Consider another strategy where the trader longs 1 unit of an asset and longs the put option for 1 unit of the same asset. From the graph, we can see that the possible loss due to the long position of the asset is protected by the long position of the put option. Thus, this combination is also known as a protective put. The long position on the put option acts as an insurance policy on the asset position, as it limits the loss should the asset price declines. However, the option premium reduces the trader's potential gains in the bull market. Next, we'll talk about spreads. A spread strategy is created with positions in 2 or more European options of the same type, same expiration date, but with different strike prices. In the following, we're going to introduce 4 types of spreads: bull spreads, bear spreads, box spreads, and butterfly spreads. A bull spread is created by taking a long call position with a certain strike price x1 and a short call position on the same underlying asset but with a higher strike price x2. Here's the payoff table of a bull spread created with calls. Let ST be the spot price of the underlying asset at the maturity time of the options. If ST is less than or equal to x1, the payoffs for both the long position of the x1 strike call and the short position of the x2 strike call are 0. Therefore, the total payoff of the strategy is 0. If ST is in between x1 and x2, then the x1 strike call will be exercised with payoff ST minus x1. But the payoff for the short position of the x2 strike call remains 0, and hence the total payoff of this strategy is ST minus x1. Lastly, if ST is greater than or equal to x2, both call options will be exercised. Note that the payoff for the short position of the x2 strike call is negative ST minus x2. Thus, the total payoff in this case is the difference of the 2 strike prices, x2 minus x1. Let C1 and C2 denote the premiums of the 2 call options, respectively. Then, the short call has a positive cash flow plus C2, and the long call a negative cash flow minus C1. Since call premium decreases as strike price increases, the net cash flow C2 minus C1 is thus negative. Therefore, a bull spread requires an initial investment, and the profit is the payoff minus the initial investment. Below is the profit table of the bull spread created with calls. It is obtained from the payoff table in the previous slides by taking into account the premiums. Note that C1 and C2 are the premiums at time 0. To calculate the profit at the maturity time T, we have to compound them from time 0 to time t. This is the corresponding profit diagram. The black solid line is the profit of the strategy. From the diagram, we can see that a bull spread limits both the upside and the downside risk for the trader adopting it. A trader who takes up the bull spread has the view that the asset price will increase. The strategy can be described as the holder of the call option with strike price X1, giving up some upside potential by shorting the call option with the higher strike price, in return for the option premium. A bull spread can also be created by taking a long put with a strike price X1 and a short put with a higher strike price X2. Now let's introduce bear spreads. A bear spread is created by taking a short put position with a certain strike price X1 and a long put position on the same underlying asset but with a higher strike price X2. With the same analysis as what we have done for the bull spread, we obtain the following payoff table. Let P1 and P2 be the premiums of the two put options respectively. Then, the short put has a positive cash flow plus P1, and the long put has a negative cash flow minus P2. Since put premium increases as strike price increases, the net cash flow P1 minus P2 is negative. Thus, a bear spread requires an initial investment as well. Similarly, by taking into consideration of the initial investment, we obtain the following final profit table of the bear spread created with puts. And this is the corresponding profit diagram. From the diagram, we can see that a bear spread limits both the upside and the downside risk for the trader adopting it. A trader who takes up the bear spread has the view that the asset price will decrease. The strategy can be described as the holder of the put option with strike price X2, giving up some upside potential by shorting the put option with the lower strike price in return for the option premium. A bear spread can also be created by taking a short call with a strike price X1 and a long call with a higher strike price X2. In this lesson, we have introduced 4 trading strategies: the covered call, the protective put, the bull spread, and the bear spread. We will continue talking about the spreads in the next lesson.